Hi there. So today I want to talk to you about a temporary interest rate buy down, not an adjustable rate. So the most common type of buy down is when you buy down your interest rate on a permanent basis. So let's say you're going to go from 6.5% down to 6%. That typically would cost a little over 1 point, and 1 point is 1% of the loan amount, and it only buys your interest rate down anywhere from maybe 1/4 to 0.5%. It's not something I typically recommend unless we've got some seller's concessions that allow us to do that. Something that's really been popular lately is what's called a temporary buy down, where we calculate the payment based on a lower interest rate. So the most common is what we call a 1.0 buy down. And so let's say today's 30-year rate is 6.5%. We can do a temporary buy down where for the first year, your payments are actually based on 5.5%. And just for simple math, let's say that payment difference is $300 a month. So we take the $3,600, we put that into an escrow account, and then every month you make your payment based on the 5.5% payment. We pull the extra $300 out and pay the difference so that you're getting the benefit of the lower payment, but the full payment's really coming from that buy down. You cannot pay the buy down yourself, but you can negotiate for the seller to pay that. So if we've got some extra closing costs on the table or something along those lines, these temporary buy downs are really a great tool to use that for. And if you're working with me or a broker that is using UWM as one of their investors, they're actually offering a free buy down right now. So it's definitely something worth looking at and exploring. I've done a couple of these with UWM already, saving the customer $300-400 a month. Great tool. Also had just closed one where we had excess seller credit on the table and we used that money for a buy down. So lots of creative ways to use it. Please feel free to reach out to me with any questions. I'm Tammie VanDeusen with Summit Lending.